Good morning, YouTube. Today is Tuesday, January 30th, and we're talking tax escrows today.
Good morning.
Somebody going to sip a coffee to talk tax escrows, huh?
Sorry we're late here on this AM chatter. I was making a cup of coffee here for the last 18 minutes.
And I was stuck in traffic, so there you go. But glad everyone could join us. We're here at World Headquarters this morning on Camp Horn Road. Threw me a little curveball today, but we're good. We're here. Welcome, everyone. We wanted to get into our topic today pretty quickly because we think it's a pretty important one. In the mortgage world, we all three throw around the word escrow a lot and talk about your escrow. And then we come to stop, we pause, and we're like, hey, guys, maybe a lot of people don't even know what an escrow is. And so we're going to explain it a little bit, go over it, why you have it, why it's there, what it is, and if you need it or not. Because there are times if you're buying a home, maybe you want to pay your taxes yourself. Maybe you don't want to use that escrow account. So we can get into that and have a blast. Anth, you ready to go today?
Let's rock and roll, man.
Okay, perfect. Well, lead us off, Senior. Talk about an escrow, what it is, why we have it, and let's go from there.
All right. So escrow accounts are considered them like a savings account with your servicer, essentially. So every time you make your monthly mortgage payment, you have a portion of that total payment, such as taxes and homeowners, going into a savings escrow account. Every month you make that payment, that escrow is building up so that once taxes and homeowners come due, the servicer actually has those payments ready to be made to the tax collectors and the homeowners insurance when they come due, which are typically county and locals typically do in March, schools usually July, August. Some are based on a calendar year, but they're definitely holding those for you. Now, ultimately, if you don't want to escrow, you got to do a minimum of 20% down on a conventional loan. If you're doing anything government financing, FHA, VA, USDA, you don't have that option. It's actually required regardless of your down payment.
Yep. I mean, that's absolutely perfect. So, I mean, pretty much the mortgage lender doesn't trust everyone to pay their own taxes, insurance throughout the year, right? So they just lump it into the mortgage payment in the short of it. Now, that makes closing costs higher. That makes it closing on a home higher because we have to set that escrow account up. You have to pay back sellers in Pennsylvania what they already paid for their taxes because they probably paid ahead of time. And that's why you'll see that large chunk as part of your closing costs. Like, why am I paying X amount of thousands of dollars for property taxes at closing? And it's because we are setting up that account so you don't have to pay taxes and insurance out of pocket when they come due. It's all part of your mortgage payment. So you're prepaying a little bit. Some folks don't like that. Why are you taking thousands of my dollars and putting it in an account that gains no interest? But as Anthony said, Tom, if you put that 20% down conventional, you can pay your own taxes and insurance if you want to, and you don't have to have that escrow account.
No, yeah, that's a good point. I mean, if you do want to manage your own money per se, instead of have the escrow account do it, you got to have enough funds to do that and make sure that we're going to try to keep you out of trouble with the government. We don't want you to not be able to pay your taxes. Something you touched on right there, it's confusing for a lot of people because we do collect a full year of taxes up front for each of those different municipality, county, and school. And people are like, well, I'm paying every month for it. Why do I have to pay up front? I'm paying every month. And, you're always paying that year ahead. So every month you're making that payment into the escrow account is actually for next year. Same with the insurance. And I think that's the biggest misconception that we get is, why am I prepaying these escrows if I have to pay them in my monthly payment every month?
A question I get on almost every loan estimate. But agents, you guys have to be the eyes for your buyers because the escrow is a zero tolerance on a loan estimate. So a lender can put anything they want on a loan estimate at your buyer's application with the tax escrows. I want to be honest, there's some lenders out there, they'll put 1 month of tax escrows to make that bottom line look lower to the buyer. But all of us in the industry know it doesn't matter what lender you use, your tax escrow at closing is going to be the same. So our philosophy at West Penn, we feel we always know as loan experts and loan originators that it's going to be pretty damn close to those 12 months, if not 12 months. So we always leave it that way. Sometimes I can compete with a lender that's showing 2 months, and I may lose that deal because it looks like the cash to close is thousands of dollars lower. That buyer is going to have a surprise at closing. So we just are here to give buyers as accurate and real numbers as possible, not just, put the wool over their eyes and show them some fake numbers. So, but if you're an agent and you want to help your buyers and you're looking at these cost sheets, look at the escrows. You'll be able to see it. I get it. There's a lot of numbers. There's a lot of words, but take a breath. It's all usually about the same terminology. You're always going to see a section setting up that escrow. It always has a number of months. If it's 1, 2, 3, or 4, that's probably really bad estimate for your buyer to see. You want to show them worst case scenarios because you don't really know at application what's going on. So that's just a public service announcement. If you're out there trying to help buyers, look at cost sheets, or if you are a buyer looking at an estimate, pay attention to that escrow so you don't get a surprise at closing.
I hear that often. I hear that actually often. I mean, they're like, oh, the buyer, this lender charged them $2,000 more than they quoted it initially. And from the lender's perspective, they really didn't. The taxes just came in higher than was on that estimate. And they really don't have any fault. So that is something you have to be readily aware of on every deal, is looking at those taxes, how much is being charged.
Yeah, I mean, Ant, it's up to every individual loan officer how much effort you put into taxes, right? We're not tax collectors as loan originators. It's not our job per se to confirm the tax amount or how much escrow they need, but you can't just close a blind eye when you're in this business every day and you know what's going to happen. And then you just go, oops, Mr. Buyer, the taxes came in higher. That's why you're paying more. It wasn't my fault. I agree. It's not the loan officer's fault, but the loan officer can help alert that buyer to what's going to happen or give more accurate numbers at application.
Yeah, I mean, that's part of the job. We're financial loan officers, so people are putting their trust in us for their financial means and advice for their loans. So, I mean, it doesn't take much to actually do the job efficiently and correctly. And most of the time we have to be, a little overachievers to make things work the right way. But, a lot of clients don't realize that they have to pay those prorations back to the seller, for anything they've already paid from the closing date up until they're due again. And some lenders will only use the escrows, but they won't put the prorations, but the unfortunate part is that's the wrong way to do it, because now your client is now surprised at closing. They probably already scraped together everything they had for the down payment closing already. And then a week before closing, they have to come up with another $2,000 for the prorations to pay back the seller at closing. So yeah, like Ryan said, definitely look at the cost sheet. Hopefully you're getting a cost sheet. And if your clients are not getting a cost sheet from their lender they're using, they need to reach out to one of us, because they don't know what they're paying until they see the cost on paper.
Yeah. And for any buyers out there, please be aware you have your down payment plus you have closing costs when you get a mortgage. I would say the biggest misconception with first-time home buyers is, hey, I saved up money for the down payment. I'm ready to buy the house. And then they have no idea that all these different closing costs happen when you're purchasing a home. And it's like, well, I had $3,000. I don't have $10,000. Maybe I can't buy a house right now. So we are here to educate, to give knowledge, to let buyers know the real cost of buying a home, and to also say, hey, there are plenty of different options out there with closing cost assistance or low down payment that you can get into a home if you don't have that giant nest egg to get in that may be required. So that's the most important part of a pre-approval. It's what we do. It's why we're here. We want to explain and give accurate, true numbers to people buying homes in Western Pennsylvania. So if you're down with that, if you're good with that, give us a call. If you want your buyers to just go out with a blindfold on and hope to God they close, don't give us a call. those are your two choices. Other than that, we'll see you Friday, and I'll talk to you guys later.